Food costs are rising all over the world, so how exactly should we be thinking about our investments in this environment? That's what we're going to be covering in this video, so smash that like button and subscribe if you're new. You're watching More Money, let's get it. What's up, guys? Barron's put out a really interesting article about which stocks that we should be looking at as food prices continue to increase. And so that's an article that I wanted to share with you today. And in this article, they mention a bunch of companies, and I noticed that two of the names that were in this article, I actually had provided valuations to my Patreons, which I'm going to provide to you guys in this video. So let's get into that article. So as you can see here, here's the mentioned article, and they are saying that food costs are rising, and here's some of the stocks to consider. So moving on, and what I wanted to show you guys is that food costs have increased. So we're up 7.9% year over year. Obviously, that's dwarfed by the increase in energy. But what I wanted to do is dig a little bit deeper into that to let you know exactly where we're seeing food price increases from. And from here, you can see that food at home categories are actually up higher than food away from home. So that's really interesting. And I guess part of that is that the primary cost of food at home, the driver is the food itself, whereas the food away from home, I think the majority of that cost would be non-food related items, so like salaries and rents and whatever else that the restaurants would have to pay. Now, that being said, digging a little bit deeper into that, you can see that the major area where we're seeing food price spikes is with meat, poultry, fish, and eggs. That's up 13%. Cereals and baking products follow closely behind that at almost 8%, and then everything else is up between 5 and 8%. So nothing is safe from the ravages of inflation that we're seeing right now. And this is as of February of 2022. And I wanted to provide you guys with not just consumer levels of inflation on food, but also the wholesaler levels of inflation, because that's an indication if we're going to continue to see higher levels of inflation. And I don't think the news is very good here, because you can see here that at a wholesale level, there are continuing pressures for rising food prices. Overall, you're seeing food price increases higher than the consumer price increases at around 14%. Beef and veal is up close to 22%. Grains are up 20%. Dairy products are up over 15%. And even fruits are up, I don't know, it looks like 14% or so. So this may be an indication that food costs are going to continue to increase for us. And so that's not good news as of February, at least. Now, they categorize some of the companies that they're recommending we purchase in this environment. So obviously you have the food companies. That's the ones that everyone thinks of. So General Mills, you have Hershey, Kellogg, and Hostess brands. I'm going to build a valuation on all of those and put them out to my Patreons over the next couple of weeks. Then they have the second grouping, which is the restaurants. So you can see Bloomin Brands, Brinker International, and Starbucks. The reason why I highlighted those three names is because my Patreons actually do have a model for each of those companies, and those names are tracked on the tracker. And so at the $5 level, you can actually get access to all of those models. So that's just a quick little plug there. But also, guys, if you guys do decide to join the Patreon and within the first month you think that it's not really for you, just shoot me a message right on Patreon and just say that it's not for me. I tried it out and no problem at all. I'll refund that month. Okay, let's get back into this. You can see that farm equipment, they got AGCO and John Deere. And John Deere is the one that I really, really want to value. And so that's going to be next for me for sure. And then you got the agribusiness stocks and the food retailers. The food retailers would be next after John Deere. So I'm going to value all of these companies. I started with the first three here that we kind of already had, and we'll move on to the next one. And so just to show you exactly what I mean about the Patreons having access to this already, you can see that Brinker International, it's currently closed at around $36 per share. And that was as of the recording of this video. And you can see that we're valuing it around $61 per share. So it's trading at around 59% of its intrinsic value. I probably wouldn't want to buy it until it's closer to 50, but you can look at the cash secured puts, which I will show you how there is an opportunity for one of these two. And then for Bloomin Brands, you can see that it closed at around $21 per share and is valued at approximately $35 a share. So it's trading at approximately 60% of its valuation. And then note the two columns to the right there. Both of these companies have debt, and I don't think either of these companies are as inflationary resistant as you would want in this environment. That being said, there's still an opportunity to purchase these names if they come well under that 50% of intrinsic value. But moving on, the article goes on to state that a strong U.S. farm economy helps John Deere, the top producer of agricultural equipment. And they're absolutely right. But here's a problem though. If there's supply chain constraints, would John Deere have the same issues that the auto companies are, where they're going to have trouble delivering supply? Now, higher food inflation does tend to help grocery stores, as this article does say, because Kroger's and Albertsons can actually generate wider margins if the consumer shifts to private label brands that are actually cheaper for them, but of course it's higher margin for the grocery retailers. So obviously Walmart would probably benefit from this as well, and you can see it in their share price that Walmart did get pushed up as a result. Now, this article goes on to state that restaurant stocks have lagged behind the overall market because investors, rightfully so, are worried that consumers are going to be squeezed by higher food, gas, and rent costs and will be less inclined to eat out. And the analyst Andy Barish over at Jefferies says that he thinks that this is an overreaction. The industry is still seeing really good demand trends and companies are taking significant pricing. So effectively, what the analyst is really saying here is there might be a separation from reality and what Wall Street thinks. And then that to me seems like there could be an opportunity here. And that's why I went ahead and valued these two names. And I already showed to you that they're getting cheap, not exactly where I would like them, but like I said, there are some cash secured put opportunities here, which I will explain in this video. So moving on, you can see Bloomin Brands, they're the owners of Outback Steakhouse. I don't really know the other brands, but that might just be because I'm in Canada and they're not up here. But overall, they have almost 1,500 restaurants in 47 states and 20 countries. Now, from here, you can see that Bloomin Brands shares really haven't gone anywhere year to date. Only up about 1%, and that might have gone down since I did the screen capture. And from here, you can see that this analyst does favor Bloomin Brands, whose shares are currently trading around that $22 per share area, which is effectively 9 times their projected 2022 earnings of $2.38 per share. So overall, it does scream that it's really cheap, especially if the company doesn't experience a slowdown that Wall Street is expecting. So then what is it going to be trading at in 2023? Do they continue to take pricing and continue to increase revenues? So that's something to really think about with these names here. But one thing that I did want to point out is when you start thinking about revenue growth, look, all of Wall Street is always projecting revenue growth. But the one thing that I do want to show you is from here, you can see from 2012 to 2021, Bloomin Brands has not significantly increased revenue. But if you look below, you'll notice that they have increased EPS from around 45 cents per share in 2012 to around 2.42 per share in 2021. Now, obviously, there's probably some items there that made the 2012 EPS look a lot smaller or lower than it should be, but be that as it may, what the trend here is showing is that they've managed to increase the profitability of their organization. So one of the things that I always like to look at is what has the company been doing with their generated cash flow. And so from here, you can see that in 2021, their free cash flow has primarily been used to pay down debt. And I think that's a really good thing because overall, this company still does have debt. From the next slide here, you can see that they still have quite a bit of debt, but notice how the debt got cut in half from the 1471 in 2012. And so that's very interesting. But also just FYI guys, I don't have the years above here for some reason. So the first year on the far left is 2012 and the last year on the far right is 2021, just FYI. But yeah, you can see that the debt has come down significantly and now it's to a point where it's manageable. But how exactly should we gauge if the debt is manageable or not? Well, I really like free cash flow metrics to debt, and so that's what I'm going to show you here. So I actually forecasted free cash flow for 2022, and it looks like their debt to free cash flow is approximately just over 3 times. So I think that's relatively manageable. I like seeing that under 5 times, so that's really good. But of course, the best number is 0. So hopefully they continue to pay down debt. But from a valuation perspective, you probably should consider that in your valuation, that they're going to probably be paying down more debt. Now, I don't know if they provide guidance on that, but it's something to look out for. Now, as for guidance, you can see that their 2022 GAAP diluted earnings per share is expected to be approximately $2.13 to $2.22, which means that the current shares are trading at approximately 9.7 times earnings. Now, obviously, the adjusted diluted earnings per share probably means that the shares are trading closer to 9 times earnings, but I'll go with the GAAP numbers. And below, also note that they're expecting that GAAP diluted earnings per share while simultaneously expecting 11 to 13% increases in their commodity prices, which is obviously their food prices. So something to really think about. Now, when it comes to the valuation of Bloomin Brands, I'm using a terminal multiple of 12.5 times earnings. So you can see here that my EPS valuation is around $35 per. So you can see here that my EPS valuation is around $35 per share. I didn't give them a discount for their debt because I think that it's relatively manageable. But of course, your valuation could come down if you give them a hit for the debt, which is totally understandable. And with the current share price of approximately $22 per share, you can see that the market cap as a percentage of value is approximately 60%, which is not exactly enticing for me. I like to buy companies under half of their intrinsic value, but of course that means that I usually miss out on a lot of opportunities because I'm such a stickler on when to buy stocks, but that's okay. That's just how I operate. You're more than welcome to operate in any way that you think is reasonable. And when I come into situations like this where the share price is close to where I'd like to buy it, I always like to look at the cash secured put. So you can see here that the $17.50 cash secured put, so $17.50 is where I'd like to buy this company, considering that I'm valuing it around $35 per share. So $17.50 is just right in the middle of that. So that's at that 50% level. Well, the cash secured put for the January 2023 exercise date yields 13.5%. So not exciting for me. I like to see at least 20%, ideally 25%, but I'll take a 20%. So it's not there yet. If the share price declines a little bit more and that goes into the 20% range or so, I might be more interested in it. And it also gives me sort of like that downside protection as well, which in this environment I'm really worried about. So that's why I'd probably pay up and give up a little bit of that upside just to keep that downside protection. Okay, now moving on to the second name that they mentioned in that article, which is Brinker. You can see here that year to date, the shares are actually down. So just under $36 per share, which means that they're down approximately 5% for the year. Now, of course, you guys are forgiven if you don't know what Brinker is. They're the owners of Chili's. And that's, of course, the significant majority of where their revenue comes from. Until doing this research, I didn't realize that Chili's had 1,600 restaurants in 29 countries. Why isn't there a Chili's near me in Toronto? That's crazy. This is the consensus projected earnings. You can see that they're trading at around 10 times their 2022 projected earnings and 8 times their 2023 projected earnings. The street really believes that Brinker will just continue to increase their earnings. And so this could really be an interesting opportunity, I think. Now, once again, I always like to look at what these companies are doing with their cash flow. And you can see here, similar to the last company that we looked at, they're essentially taking all of their free cash flow and paying down debt, which is really good to see. So the question is, how is their debt looking? Well, so from here, you can see that I've projected 2022 free cash flow. I might be low on my projection for free cash flow. I'm projecting it at around 200 million. And so you can see that their debt to free cash flow is around 5 times. Now, that's closer to the high end of what I'd like to see it. I really would like to see that around 2.5 times. Obviously, 5 times is manageable, but 2.5 times is kind of that sweet spot. So like that 2 to 3 area, which you can just continue to hold that debt, and I'm okay with it. Here, I would almost penalize them a little bit. I didn't in my valuation, but I'd be more inclined to penalize them for this debt. And I think overall investors do that. And so the one redeeming and interesting thing for Chili's is how they focused so much on technology. You can go into a restaurant and order on one of those handheld devices, or I think the servers walk around with the handheld devices to order on, which is even better. There is tabletop technology, which I don't know exactly what that is. That might just be games. And you saw Buffalo Wild Wings do that. And it's a huge success, especially for families. But the one area that I think technology is really benefiting this company is digital sales. So partnering with DoorDash, Uber Eats, launching virtual brands like their It's Just Wings virtual brand. That's the name of the game right now. That's what's going to succeed for restaurants into the future. And you can see that it's working because their digital sales as a percentage of their total sales skyrocketed to 34% in 2021. Now, that might come down because there was lockdown, so that could come down, but we'll see how that progresses. Now, as you can see here, the meal delivery services like the Uber Eats and the DoorDashes, that continues to grow. It looks like DoorDash is really taking over the industry. You guys already know on this channel, I did 250 deliveries on Uber Eats. The one thing that I noticed is that people ordered indiscriminately. So whether it be Starbucks or restaurants or McDonald's or whatever, people are ordering from every one of these places. I did so many orders from every single one. So I like the idea that a restaurant is embracing this and making brands that are sort of Uber Eats and DoorDash exclusive or delivery exclusive. So that's really interesting for me. So what Brinker has done is they've embraced sort of that ghost kitchen thing. So what that really is ghost kitchens, if you guys aren't familiar with it, is like one sort of facility that will make food for many different brands. Well, if you think about their locations, if they have like 1,600 locations all throughout the world, why wouldn't they turn each of those locations into a ghost kitchen for their digital only brands like their wings company? And so that's exactly what they've done. You can see them stating here that the ghost kitchens are growing rapidly, and you can see that the 2027 ghost kitchen estimated restaurant sales had to be revised upwards by 65% post-COVID because so many people got used to ordering their food online. They're more comfortable with it now. That only benefits companies that have already started embracing this, and that's what I really love about this company. And so when you come to my valuation, you can see that I actually highlighted on the top that they are a brand that's focusing on digital, and I think the restaurants that focus on digital are the ones that are going to be successful. So Chili's, I'm really behind you guys. I really want you guys to succeed. My EPS valuation is around $60 per share. The current share price is around $36 per share. I wouldn't buy this company for anything over $30 per share. So like I told you guys, anytime the share price is really close to that 50% of its intrinsic value or less, I like to look at the cash secured puts to see if there's a yield that's enticing for me to enter into. And that's what I did find here. So you can see here that the $30 per share strike price for January 2023 is yielding a premium of approximately 4.2 to 4.9. So that's going to give you around a 20% yield. So that's really interesting. And of course, there is downside protection here as well. So if I were to get a premium of $5 and I'm already willing to buy the company for $30 per share, and if the market just completely tanks, at least I got that additional $5 per share of cost basis decline because I received that premium up front. So something to think about in this environment where we could sort of go over a cliff. That's kind of what everyone's saying with the inversion of the yield curve and stuff. So I've kind of been cautious since 2021. I've only really been investing in top tier companies. And if it's companies that are not really top tier like these ones, I'm really going under that 50% of intrinsic value just to make sure that I have a huge margin of safety. And so once again, as you guys can see here, you can get access to all of these models on the Patreon at the $5 a month tier. And once again, if you guys are not interested after you take a look around and it's not really for you, just shoot me a message, which you can do right on Patreon. And within the first month, I'll completely refund everything. But with that being said, I'm going to be valuing all of those companies that this article mentioned because it's very interesting and it's an area that I've typically not really spent a lot of time in. So it'll be really interesting to understand these companies, what makes sense for them in terms of valuations. Now, that being said, I do want to turn your head to another piece of interesting news. Elon Musk, although he said yesterday that he was doing a passive investment with Twitter, it was just announced today that he's going to be joining the board of directors. So that's very interesting. And so if you guys haven't seen my take on where I believe that Elon Musk and the current CEO do have synergies, I highly encourage you to check out this video right here.